Last time we talked about pricing perpetuities and annuities. This week we'll move on and talk about pricing bonds more generally. So bonds are debt that's held for a fixed term. So bonds can be issued by governments, municipalities, corporations, all sorts of entities. And so bonds are generally considered to be relatively safe assets, being fixed income securities. However, they're not completely free of risk. There's always a chance that the borrower is going to be unable to repay, and so therefore there's always a chance of default. However, compared to things like stocks, which we'll be talking about later on, bonds are generally considered to be pretty safe. So the simplest type of bond we can think about is called a zero coupon bond. And a zero coupon bond is just a bond where you buy the bond now and then you receive the payment in full at maturity. So the face value of the bond, or the par value, is how much you're receiving at maturity. And typically the price of a bond is going to be quoted as a percent of the par value. So for example, we usually assume, and whenever we don't state this specifically, we're going to assume a par value of 1,000. So if I have a bond that's priced at 903 3/4, that means for every 1,000 in par value, it's going to cost me this much to buy the bond. And so I can think of the price of the bond as being the present value of receiving this payment of 1,000 at maturity. So let's say I have a 3-year bond that's selling for 903.75. That means the present value is equal to 1,000 divided by 1 plus the interest rate, or the yield, to the third, and that equals the price of the bond, which is 903.75. So what I can then do is I can then solve for the yield. So the yield is going to be 1,000 divided by 903.75 to the 1/3 minus 1, or about 3.4%. So if the bond is priced on the market as 903.75, that means that the yield, the interest rate on the bond, is going to be about 3.4%. That's the discount rate that will return the bond price as the present value. So a zero coupon bond, you pay now and you get paid back as a lump sum later. However, this is not the only type of bond we can buy. We can also buy what's called a coupon bond. And so a coupon bond, rather than getting paid back all at once, you're going to receive periodic interest payments, or coupon payments, throughout the life of the bond. Let's say you have a 3-year bond, still have a par value of 1,000. And let's say we have a coupon of 56.25. That means in year 1, 2, and 3, I'm going to receive a coupon payment in year 1, a coupon payment in year 2, and then in year 3, I'm going to receive a coupon payment plus the face value. So this 3-year coupon bond is going to have this stream of cash flows. So you can think about the coupon payment as reflecting the interest payments that you would expect to receive. However, there's an important thing that we need to make sure to remember here. The coupon rate of this bond, which here is about 5.6%, is set by the terms of the bond. All right, so it has a coupon rate of 5.6%, but that does not mean that this is the bond's interest rate. So let's suppose that this bond is issued by the same entity that issued the zero coupon bond in the first example. And the zero coupon bond in the first example had a yield of about 3.4%. And as we'll see later on, the yield of a bond can be taken as a measure of the borrower's creditworthiness. So if it's the same borrower, then this coupon bond should also have the same yield. Now, we can compare the yield with the coupon rate. So the coupon rate is about 5.6%, but the yield, the discount rate, is only about 3.4%. So what does that mean? That means that this bond is paying back more, quote-unquote, interest than it should, right? The coupon payments make up for the interest and then some. So what does that say about the price of this coupon bond? Well, in order to calculate the price of this coupon bond, we write out the present value. So 1 plus y, that's 1.0343 plus 56.25, 1.0343 squared, plus 1056.25, 1.0343 cubed. That's going to give us a present value of 1061.55. So what this means is that this coupon bond sells at a premium. The price of the bond exceeds its face value. Compare that to the zero coupon bond we looked at earlier, which sold at a discount. So why does this coupon bond sell at a premium? Well, because the coupon payments it promises more than make up for the interest. So because the coupon rate exceeds the discount rate, the present value of the bond is going to exceed its face value. So a special type of bond that we're going to be considering are Treasury securities. These are issued by the US government. And because the US government is considered to be a very creditworthy borrower, Treasury securities are about the closest thing we can think of to a risk-free asset. And therefore, Treasury rates are going to be what we reference as a baseline when we're thinking about what the risk-free rate of interest might be. By the way, this does not mean that Treasuries are completely safe. However, they're about as close as we're going to get in the real markets. So Treasury securities pay their coupons semi-annually, so twice per year. And so if we have a series, let's say the 2.5s of 2024, that means that the coupon rate is 2.5%. So if I have 1,000 in par value, that means I'm getting an annual coupon of 25. However, because Treasuries pay their coupons semi-annually, I'm actually getting paid 12.5 every 6 months. Right? So if I'm looking from the perspective of May 2020, then in November of 2020, I'm getting 12.5. May of 21, getting 12.5. November of 21, getting 12.5. May of 22, 12.5. And so on. Until May of 24, in which I get paid the face value plus 12.5. So if I bought this Treasury security in May of 2020, that's going to mature in May of 2024. I'm going to receive 8 coupon payments of 12.5 every 6 months. And then at the end, in May of 2024, I'm going to receive the face value of 1,000. Okay, so we have, for this bond, we have a yield of about 0.2%. Treasury rates at this time were very low, but because this is an annual yield, we need to divide by 2. So the 6-month discount rate we're going to use is about 0.12%. And so to calculate the present value of this bond, we're going to think about the Treasury as being a combination of an 8-period annuity and a single lump sum payment of $1,000. So if you recall, the coupon was 12.5, which means that the present value is going to be 12.5 divided by this 6-month interest rate times 1 minus 1 over 1.00126 to the 8. This is going to cover the coupon payments. And then I'm going to tack on 1,000, which comes after 8 periods. That's going to give me a present value of 1089.41. So that would be the price of the bond. As you can see, once again, this bond is selling at a premium. Why? Because the coupon rate is 2.5%, whereas the yield is only about 0.2%. And so as long as the coupon rate exceeds the yield, the bond is going to sell at a premium. So if you look at this graph will show you a picture of the Treasury rates over time. And what you can see is that Treasury rates sort of spiked in the late 70s, early 80s, and this was a result of a policy where rates were kept high for a long period of time in order to try and deal with inflation. More recently, especially after the 2008 financial crisis, Treasury rates were kept historically low for a very long time, almost near zero, up until fairly recently. And it's only fairly recently that rates started to come back up because of this threat of rising inflation once again. So depending on when you're watching this lecture, you can look at what the Treasury rates are in your current time and compare it with the historical trends. So as we can see, there's a very important relationship between the price of a bond and its yield. And specifically, there's an inverse relationship. The higher the yield, the lower the price. And this makes sense because the yield goes in the denominator of the present value, right? So a high yield means that you're discounting the future payoffs by more, which means that the bond will be worth less. And the relationship between price and yield is also going to depend on the term of the bond. If you think about a long-term bond is going to be much more sensitive to changes in the yield, because you think about like a 30-year bond, a small change in the discount rate is really going to affect the value of the bond, because you think about compound interest over 30 years, even a small change to the interest rate is going to really affect the value of those payoffs that come far in the future. So in this picture, you can see the price yield curve, where the yield is plotted on the x-axis and the price is plotted on the y-axis. And you can see that the higher the yield is, the lower the price, and that for the longer term bond, the relationship is going to be more extreme, right? A longer term bond is going to be more sensitive to changes in the yield because its payoffs are coming farther in the future. And you'll notice that these two lines intersect at the point where the yield equals the coupon rate, because if the yield equals the coupon rate, the price of the bond is going to equal the face value, in this case 1,000, regardless of the term. So that's where the two curves intersect. So now let's imagine we have some entity that's issuing bonds with a face value of 1,000, and it's offering two different bonds. I have a 1-year bond that's priced at 952.38 and a 2-year bond that's priced at 857.34. So if I want to calculate the yield of the 1-year bond, that's going to give me a yield of 5% if I solve this equation. And if I want to calculate the yield of the 2-year bond, that's going to give me a yield of 8% if I solve this equation. So now, so far, we've been talking about the interest rate as if it were a single number. However, a situation like this could very possibly occur, right? Because the prices of these bonds are set by the market. So the market has determined the 1-year bond is worth 952, and that the 2-year bond is worth 857, which implies a 1-year rate of 5% and a 2-year rate of 8%. So is this allowed? Is it possible that the same borrower could issue a bond with a rate of 5% and then another bond with a rate of 8%? Is this allowed? So, of course, the answer is yes, this is perfectly allowed. Interest rates can vary by term. And if I plot the interest rate against the term, I get what's called the yield curve. Okay, so we need to make sure we don't confuse the yield curve with the price yield curve. So the yield curve plots the yield against the term, whereas the price yield curve plots the yield against the price, the present value. The price yield curve is an intrinsic relationship. No matter what type of bond I'm talking about, the higher the yield, the lower the price, just because of the nature of the present value equation. The yield curve is an empirical relationship. Typically, we're going to see that longer-term bonds have higher yields. However, this does not always need to be true. Sometimes we'll see what's called an inverted yield curve. And this is where longer-term bonds are actually going to have lower yields than short-term bonds. So here we can look at two examples of yield curves for treasuries. So in October of 92, we have a standard upward sloping yield curve. So longer term bonds are going to have higher interest rates. By the way, these are annual interest rates. It's not just the fact that having a longer term bond means that because of compound interest, you get a higher overall return. The annual interest rate for longer term bonds is higher. Whereas in August of 81, we had what is referred to as an inverted yield curve, where longer term rates are actually lower than short term rates. So, as a general principle, an inverted yield curve is a sign that something is wrong, that there's some kind of trouble brewing. So typically we like to see yield curves that are upward sloping, and if we have downward sloping yield curves, that's telling us that something's up. We've established that it's possible there's going to be a difference between long-term bond rates and short-term rates. However, this seems like it creates for us an opportunity to make some money, right? Because we want to think about, okay, regardless of what our portfolio consists of, all that we really care about is the payoffs that they promise, right? So regardless of whether I have a portfolio of long-term bonds or I have a portfolio of short-term bonds, kind of one after the other, so whether I have a single 10-year bond or I have a 5-year bond followed by another 5-year bond, those should behave the same way, right? And if those behave the same way, and they have the same payoffs, then they should have the same price. And if they have different prices, and if the yields are different, that means they have different prices, then there should be a way for me to profit from this difference. So let's think about what we can do if we have a 1-year interest rate of 5% and a 2-year interest rate of 8%. So, what's a 2-year bond? Well, a 2-year bond is basically just a 1-year bond followed by another 1-year bond, right? So, if I have a 2-year bond, I invest X today, and I get X times 1 plus R2 squared after 2 years. So instead of doing this, I should just be able to invest in a 1-year bond. So I invest X today, I get X times 1 plus R1 today, and then I invest in another 1-year bond. So I'm going to reinvest X times 1 plus R1, and then I'm going to get a payoff in year 2. Well, what payoff am I going to get in year 2? The payoff I get in year 2 is going to depend on the 1-year bond rate today, and then it's going to depend on whatever the 1-year rate is in the future. Well, do I know what that is? Well, no, right? Because bond rates fluctuate. I can't predict today what the bond rate will be next year. So if I try to replicate a 2-year bond using a sequence of 1-year bonds, they're not the same thing, right? The 2-year bond guarantees me an 8% return over 2 years. If I do this other portfolio, I know I'm going to get a 5% return the first year, but the second year, the return I'm going to get is going to be whatever the interest rate is in year 1, which I don't know today. Okay? So, what is that telling me? That's telling me that differences in the spot interest rates are perfectly valid, right? There's no kind of profitable opportunity that I can exploit because of the difference between the 1-year and 2-year spot rates. So if I have a 1-year spot rate of 5% and a 2-year spot rate of 8%, while it seems like there might be some kind of price difference I can exploit, that's not really true because I can't exactly replicate the 2-year bond using 1-year bonds because the 2-year bond guarantees me 8% for 2 years, whereas the 1-year bond, I only know what the interest rate is for the first year. The second year, I have no idea. So let's try to close that gap by thinking about a type of contract called a forward contract. So a forward contract is a type of derivative, and we'll talk about derivatives a little bit more later on in the course. But a forward contract says, okay, in year 0, I'm going to agree to buy a bond in year 1. And the bond is going to mature in year 2. So, year 0, we make the agreement. Year 1, the transaction takes place. Year 2, the bond matures. And more than that, we're going to fix the interest rate. So, R2 goes from year 0 to year 2. R1 goes from year 0 to year 1. Therefore, what we need to actually replicate the 2-year bond is we need something that reflects an interest rate between year 1 and year 2 that we know today. That's called the forward rate or F12. So if I buy the forward contract, I'm committing to this transaction in year 0, but I'm not investing anything today. I'm going to invest X times 1 plus R1 in year 1, and then in year 2, I'm going to get a payoff, X times 1 plus R1 times 1 plus F12. So the return between year 1 and year 2 is given by this forward rate, and this forward rate F12 is fixed today. So I have a guaranteed rate of return going from year 1 to year 2. So this is going to close the gap because R2 goes from year 0 to year 2, R1 goes from year 0 to year 1, and the forward contract F12 goes from year 1 to year 2. So if I combine a 1-year bond with a forward contract, I can exactly replicate the 2-year bond because I'm getting a guaranteed rate of return between year 0 and year 2. So with the 2-year bond, I invest X today, and I get X plus 1 times 1 plus R2 squared after 2 years. With the forward contract and the 1-year bond, I invest X today, I get X times 1 plus R1 after 1 year, but I'm reinvesting this, and then I get a return equal to the forward rate after year 2. So these are both portfolios where I put in X today, and I'm getting a guaranteed payoff in 2 years at rates that I know. So contrast this with the first attempt we made to replicate the 2-year bond, where the return on the second 1-year bond was not known today. So because these portfolios should be identical, these payoffs should be identical, which means I have this equation that allows me to determine what the forward rate must be in order for R1 and R2 to match up. So the forward rate is going to equal 1 plus R2 squared divided by 1 plus R1 minus 1. So more generally, if I have a short-term bond with a maturity of t, little t, and a rate of r little t, and then I have a long-term bond with a duration of big T and a rate of r big T, I can define the forward rate between little t and big T, which covers the gap between time little t and time big T. And that's going to give me an equation where f little t big T is equal to 1 plus r big T to the big T over 1 plus r little t to the little t, all to the 1 over big T minus little t minus 1. So if I have a long-term rate and a short-term rate, I can calculate a forward rate between time little t and time big T. So in our example, when R2 was 8% and R1 was 5%, the forward rate is about 11.1%. So we said that the forward rate must be related to the spot rates by this equation that we showed. But if you think about it, there's a market for 1-year bonds, there's a market for 2-year bonds, and then there's a market, albeit a smaller market, for forward contracts. And well, the market price for all of these things, and therefore the market interest rates, should be able to vary independently, right? So what if it were the case that the forward rate were lower than it was supposed to be? What if F12 was only 10%? Well, this is an important principle that we're going to come back to over and over again in this class. That because of this fact that two portfolios that are the same must have the same price, that means that there's going to be relationships between the prices of various assets that are still traded independently. So what that means is that the market prices for all these different assets need to line up. And if they don't line up, well, we have an opportunity to exploit that pricing gap to make money, and this is called arbitrage. So let's think about what's going on here. Here, the forward rate is too low. When you think about rates, well, rates are inversely related to prices. So if the forward rate is lower than it should be, basically what that means is that the forward contract is overvalued. So if I have two portfolios that should be the same, but they have different prices, how can I make money? Well, if I have two things that should be identical but have different prices, I should buy the undervalued one and sell the overvalued one. So when the forward rate is lower than it should be, that means the forward contract is overvalued. So I want to buy the thing that's undervalued. Well, what is undervalued? That's the 2-year bond. Let's buy the 2-year bond. So in year 0, I have to pay the cost of the 2-year bond. Year 1, I get nothing. Year 2, I receive 1,000. And I want to sell the overvalued thing. So I want to sell the 1-year bond, and I want to sell the forward contract. Now, how much do I want to sell? Well, I want my payoff in year 2 to exactly cancel. So I am going to sell 1,000 in face value worth of forward contracts. And how much am I going to receive for those forward contracts in year 1? Well, if the forward rate is 0.1%, I'm going to receive 1,000 over 0.1, or about 909 in year 1. And then what I'm going to do, I'm going to sell 1-year bonds to cancel out my payoff in year 1. So I'm going to sell 909 worth of 1-year bonds. And how much am I going to receive for those? I'm going to receive 909 divided by 1 plus R1, or about 865.8. So if I look at my overall payoffs to this portfolio, I've specifically engineered it so that the payoffs in year 2 zero out and the payoffs in year 1 zero out. But the payoffs in year 0 do not zero out. In fact, I get a little bit extra. I get 8.46. So what have I done here? I've constructed a portfolio where I make a guaranteed profit today with no future obligation and no risk. And I was able to do this because I saw a mispricing. The forward contract had a lower rate than it should have had according to the formula we showed before. That means the forward contract is overvalued. So I'm going to sell a portfolio that I consider to be overvalued, buy the portfolio that's undervalued, and because of the price difference, I can guarantee myself a positive payoff today with no risk and with no additional obligation to pay more in the future. Okay, so if the forward contract has a lower yield than it should have, then I have a way to exploit this and make money. But what if instead the forward rate were 12%? So it's higher than it should be. Then how can I exploit this? Well, if the forward rate was 12%, that means the forward contract is now undervalued. So I'm going to take this portfolio and I'm going to do the exact opposite thing. So I'm going to sell the 2-year bond. I'm going to buy the 1-year bond. And I'm going to buy the forward contract. So these become minus signs. But these I have to recalculate a little bit. So what am I going to do? I'm going to buy enough in forward contracts to receive 1,000 in year 2. And so how much do I have to pay for that in year 1? I got to pay 1,000 divided by 1.12, or about 892.86. And I'm going to buy enough in 1-year bonds to cancel out this payment in year 1. So how much is that going to cost me? It's going to be 892.86 divided by 1.05, or 850.34. And if I look at what I have now, once again, the payoffs in year 2 zero out, the payoffs in year 1 zero out, but the payoffs in year 0, I end up with a positive payoff again. So I know, according to the law of one price, that 1 plus R1 times 1 plus F12 has to equal 1 plus R2 squared. Which means that the forward contract has to have a rate of 11.1%. If it's lower than this, I can construct an arbitrage portfolio and get free money. If it's higher than this, I can flip my positions to create another arbitrage portfolio and still get free money. So as long as the forward rate is not exactly what it should be according to this formula, there's a way for me to exploit this mispricing in order to get a guaranteed payoff. Now, this is going to lead us to an important conclusion because, well, there is no such thing as this kind of free lunch, which means that it should not be possible that the forward contract has a yield of anything other than 11.1%. Another instance in which we need to consider the term structure of interest rates is when we're pricing coupon bonds. So when we had a coupon bond pricing formula before, we used the same interest rate to discount all of the payoffs. But if we know that the interest rate can vary by term, then well, we have a little bit more information that we can use to price coupon bonds correctly. So we have a 2-year coupon bond with a face value of, again, 1,000 and a coupon of 50. Well, what's the price of this bond going to be? We know that the 1-year rate is 5%, so we should discount this first payment of 50 by 5%. And we should discount this second payment of 1050 not by 5%, but by 8%, which would give us a price of about 947.8. So why must this be the price of the coupon bond? Because if you think about it, this coupon bond is just a combination of a 0 coupon bond, a 1-year 0 coupon bond with a face value of 50, and a 2-year 0 coupon bond with a face value of 1050. And this must be the price of that 1-year 0 coupon bond. This must be the price of that 2-year 0 coupon bond. If any of this did not match up, once again, we have an arbitrage opportunity. There's some mispricing that we can exploit for a profit. Now, what we can also do is we can calculate the yield of this coupon bond. So the yield of the coupon bond is going to be the discount rate that produces the same price. And the yield here would be about 7.9%. So the important thing to recognize here is that the yield, just calculating a single yield for this coupon bond, kind of suppresses this term structure. So we're getting less information by calculating the overall yield than by discounting each year's payments differently. And if you think about the overall yield on this bond, you can think about it sort of like a weighted average of the yields in each year. And because most of this bond's payment comes in year 2, the yield is going to be closer to the 2-year rate than to the 1-year rate. So let's come back to the yield curve a little bit. So what we saw from our equation was that if R2 was bigger than R1, then the forward rate was going to be bigger than both of them. You can think about the 2-year rate was sort of going to be the average of the 1-year rate and the forward rate. What that means is that if I have an upward sloping yield curve, one way to explain that is that, well, if the long-term rates are shorter than the short-term rates, that means that I expect short-term rates to rise in the future, right? You can think about the forward rate as being our best estimate of what the future 1-year rate is going to be. So an upward sloping yield curve might mean that we expect interest rates to rise in the future. However, there is a problem with this logic, because if this expectations theory were true, then the fact that we see upward sloping yield curves most of the time would mean that short-term rates were kind of consistently rising over time, and this is obviously not what we see. So another way of thinking about this is from the perspective of risk. You can think about long-term rates will tend to be higher than short-term rates, not just because people expect rates to rise, but because long-term bonds are more exposed to risk, right? You're sort of committing to putting your money in the long-term bond for a much longer period of time, and whatever happens during that time you have to deal with. Whereas if you're investing in a sequence of short-term bonds, you can reevaluate your strategy as more information comes in. So there's sort of an inherent riskiness to long-term bonds, and this will be a theme that we'll see repeatedly throughout this course. If there is something inherently risky about a type of asset, then in order to attract investors, it has to pay a higher return to compensate for that. Another thing that we might want to think about is inflation. And of course, long-term bonds are going to be more exposed to changes in future inflation rates. That's another thing we might consider as being a reason why we have this upward sloping yield curve most of the time. Let's think about inflation a little bit now. Let's imagine I invest 1,000 in a 1-year bond with a yield of 6%. And we're going to call this the nominal yield of 6% because I'm investing $1,000 today. And in 1 year, I'm getting 1060 back. So that's the yield in money terms. However, because of inflation, the return that I get in purchasing power terms is going to be somewhat less than this. So let's imagine that the only commodity that I care about is cupcakes, and that the price of cupcakes in year 0 is 1, and in year 1 is going to be 1.03. So I have a 3% inflation rate. So another way to think about this investment is that I'm investing 1,000 cupcakes today, and I'm getting back, well, 1060 divided by 1.03, only about 1029 cupcakes next year. So yes, while I may have gotten a 6% return in money terms, my return in cupcake terms, my real return, was only about 2.9%. So I can think about the real interest rate as being 1 plus the nominal rate divided by 1 plus the inflation rate minus 1. If I'm being lazy, I can just approximate this by subtracting the inflation rate from the nominal rate. However, this way of doing it is more accurate. Of course, in reality, inflation is a little bit more complicated than just the price of one commodity, because the prices of different goods and services are going to rise and fall at different rates. So typically, inflation is measured by some weighted average, known as the Consumer Price Index. And so now we're not going to spend too much time talking about what causes inflation, but in broad strokes, inflation is going to be good for borrowers and bad for savers, right? Borrowers are paying back their debts in money that's been devalued, whereas savers are going to get a lower real return than they anticipated. Now, there's a common misconception that inflation is just caused by overprinting of money. And yes, while that is a contributing factor, it's not the only thing that's happening, all right? I would say that the primary cause of inflation is inflation expectations. So what does that mean? If I anticipate prices to rise in the future, I'm going to adjust my behavior as a consumer, because if everything's going to get more expensive, I'm going to make all my purchases now. And not only am I going to do that, everybody else is going to react the same way too. So high anticipated inflation means that we're going to have higher demand. And if I have higher demand, that's going to push up the price of goods and services. So basically, the anticipation of inflation causes inflation to actually manifest. Under the rational expectations theory, the real interest rate should stay relatively stable. So the rate of return in purchasing power terms should be relatively stable, and the nominal rate should fluctuate with inflation. So when inflation is high, nominal rates will increase and real rates will stay about the same. When inflation is low, nominal rates will drop, but the real rate will stay about the same. This is not going to be true, of course, if I have unanticipated inflation, right? Because if I have unanticipated inflation, then that means the real return I realize is going to be lower than I anticipated. So if I'm concerned about the risk of inflation, I can buy inflation index bonds. So these are just bonds where the payoff is indexed to something like the CPI, and they're going to guarantee me a real rate of return rather than a nominal rate of return. Of course, because I'm getting sheltered from inflation risk, the return that these types of bonds promise is typically extremely low. So if I look at this chart, we can see that in fact, Treasury rates, the nominal Treasury rates, do more or less track inflation pretty closely, which means that while the expectations theory doesn't hold exactly, it's a good approximation. And we can see here that real rates sort of remain in the same ballpark throughout. So we've seen how interest rates can vary by term, but interest rates can also vary by the issuer, right? By the creditworthiness of the borrower. So I think about a borrower that's more likely to default, right? Well, because they're more likely to not be able to pay back what they promised, they will have to promise to pay back more to compensate. So this once again comes back to that relationship between risk and return. a borrower that's less creditworthy is going to represent more of a risk. And so in the event that they do pay back, they need to promise a higher interest rate. So creditworthiness is assessed by these rating agencies, and we can broadly divide bonds into two categories. We have investment grade, and we have high yield or junk bonds. So, by the way, the name junk bonds does not mean that junk bonds are somehow inherently fraudulent or that you would have to be really dumb to invest in them, okay? For the most part, junk bonds are acknowledged to be more risky, and therefore they must promise a higher return in order to entice investors. And people who invest in junk bonds, more or less, this is not always going to be true, of course, but more or less understand that there's going to be an additional level of risk associated with them and are willing to accept that in order to potentially get a much higher return. On the other hand, with investment grade bonds, these bonds are considered to be pretty safe. More than likely, you'll get paid back on time, and therefore, they're not going to promise a very high return. So in this table, you can see bonds issued by a number of companies, and you can see that the companies with better ratings are going to have lower yields, right? Because they don't need to promise high yields in order to attract investors. Whereas companies with really bad ratings need to promise really high yields to get anyone to be willing to buy their bonds. So you can see that this variation can be pretty extreme. For Johnson & Johnson, which is a AAA rated bond, the yield is only about 1.12%, whereas for AMC, which is a junk bond with a CCC rating, that yield is all the way at 36%, which reflects a very high likelihood of default. There is one more thing separating investment grade bonds from junk bonds, and this will be a topic that we'll touch on later in this course as well, and that's liquidity. All right, so let's imagine I've bought a bunch of AMC bonds, and I see that this company is about to default. Well, what can I do? Well, what if right before the company defaults, I sell all my bonds to somebody else and make it somebody else's problem? Well, I think that you can see immediately the problem with this plan. If I can see that the default is coming, then everybody else more or less can see it too. And so if I have a bunch of these junk bonds that I'm trying to sell on short notice, well, it's going to be very hard for me to find a buyer, especially if I want to get any kind of decent price for these bonds, anywhere near close to, for example, where I paid for them. So this is telling us that junk bonds tend to be illiquid. They're difficult to trade, right? It's hard to find a counterparty, and if I can find a counterparty, then either I need to accept a price below what I was expecting, or I'm going to have to wait before I can trade. Compare that to an investment grade bond. If I was trying to sell Treasury securities, well, this is not something that I'm going to have very much difficulty finding a counterparty, right? If I were trying to sell the Treasury securities, it would be easy for me to find a buyer, and I wouldn't have to accept much of a discount, if any. So this is the idea of liquidity, right? Liquid assets are easy to trade, easy to find a counterparty, they execute quickly, and there's not much of a price impact because treasuries are something that lots of people buy and sell on a regular basis, and so therefore there's no signaling information. If I'm trying to offload a large number of treasuries, nobody is going to interpret that as some kind of signal about the creditworthiness of the US government. On the other hand, if I'm trying to offload a bunch of AMC bonds, then that's going to raise red flags everywhere. It's like, well, what does this person know about AMC that's motivating them to sell all of their bonds on such short notice? If the market didn't know that the company was about to default now, if the market didn't know that the company was going to default before, they certainly do now. All right, so that's the idea of liquidity, and we'll be exploring this concept more in future lectures.